Today, I want to talk initially about the Asian session. So since we're going to be talking about that time of day, we're going to see how to use this new day opening gap theory with that time of day. The session starting at 6 o'clock, okay? We're going to zoom in this little area right here, all right? Here is the 5 o'clock, or in this case, 4:59 candle that closes, and the final print on that candle, we open up, and that's the opening price down here, okay? So between the difference of where we closed at the 5 o'clock hour and where we opened at 6 o'clock, that is what? That's your new day opening gap. And since we opened lower than where we closed, that means we have a discount, lower opening. When we have this in here, we're waiting for the market to do what? We're waiting for the market to create motion around this new day opening gap. Do not trade initially. As soon as you get the gap noted here, you're not in there trying to trade off of it. Why? Because there's an element of time that has to be referred to first. Because as I mentioned, the markets will not move until it's time for them to move, which is algorithmic. Yes, price will gyrate. They may have meaningless, aimless little movements, okay, that I'm not interested in. But when time is now introduced as the factor that's the greatest importance, that means at 7 o'clock to 9 o'clock, that's your Asian session. You can use this new day opening gap now and build it around the element of liquidity. But I'm going to maximize this chart here, and I want you to see what we have done. We created a high, and then we had created another high. So what is this high here in relationship to this one? Relative equal high, okay? So above this high, there's liquidity in the form of buy side. So now we have the market that opened at 6 o'clock. We traded above, short-term high. You can annotate that as a minor buy side liquidity pool. It drops down, takes out this low. You can annotate that as a minor sell side liquidity pool. But what you're waiting for is you want to see price do two things. You want to see it leave the new day opening gap. You want to see it cross over it and go below it. When it goes below it, you don't want to see it just trade below it for the sake of going below the lowest low of it. You want to see a short-term low taken. It does that. See that? So what has it done? It set an initial range to build and engineer liquidity. We have a short-term sell-side liquidity pool below here, and we have a short-term buy-side liquidity pool here at 6 o'clock. And then we have the new day opening gap. So we have new day opening gap, and what we're watching at that very moment is you want to see it trade away from it, which it does. Is it going somewhere randomly? No, it's just going in here to do what? It sets an initial range for building and engineering liquidity. That means now there are going to be buy stops that form right above this high. So what we've done is we've taken out this short-term low, and we created an initial sell-side liquidity pool, and we went above this short-term high, and we created an initial buy-side liquidity pool. Okay. Why is that classified like that? Why am I labeling that high, and why am I labeling this low? And why is it initial buy side and initial sell side? Because we've opened a new day at 6 o'clock. We created the inefficiency that is the new day opening gap. It's moved away. That's the first thing we're looking for. It needs to move away from it. It does so. What is it going to do? It takes out the short-term buy side. Does it go back down below the new day opening gap? Yes. Why? Because the algorithm is calibrating and setting, and this is visually representing how the algorithm engineers liquidity. It takes a short-term pool of liquidity out and then goes to the opposing side below this low. Now there's a new low and a new high after 6 o'clock. You see that? This is the initial high and the low that every trader that trades at that moment is going to refer to for where their stop loss is going to be. So this is no longer a factor. So while that's important to have on your chart for the purposes of learning, you want to kind of like keep it muted. You do want to have it initially as a screenshot while it's doing this. When it runs up here like this, when it does that, screenshot it. And then later on, if it rolls down and take out that low, screenshot it again. Because you want to see these screenshots as they go to the levels of interest. Like this, it should do that. Now, what happens if it did this? If it was in here and it went down there first and it took out that low? Okay, you would screenshot it as it happens, and then you would anticipate it running above this high. And what you would do, Classically, it will do that. There are times when we start the new day at 6 o'clock and it'll just dilly-dally around and do nothing. And it won't even bump above or below. If it doesn't do that, don't worry about it. So now we have initial sell-side liquidity for the day and initial buy-side liquidity for the day. Outside of those two reference points, then you look to the left and say, okay, where are the larger pool of liquidity? Well, obviously it's here. So if we have that, once we broke through here, we have to see it do another characteristic with the new day opening gap. We have to move away from it initially, go to a short-term high to take liquidity out, which it does here, and then drops down below, crossing over the new day opening gap. So this is where you want to see it coloring outside the lines. This is the logic behind it, okay? You want to see it trade away from the new day opening gap as it formed, and if it goes up, it's taking a short-term high out, and then you want to see it cross back over it and seek a short-term low, which is what it's doing here. Once it does that and it crosses back into it again, we have now set initial buy-side liquidity and initial sell-side liquidity. Now you're going to wait. What are you waiting for, ICT? When's the time of day for Asia? 7 o'clock. Okay. Go over here to the vertical line. So now we have what happened. The market crosses back above new day opening gap. Does it take out the low here, right there? As we're heading into 7 o'clock, what is it doing? Is it moving to this low to challenge this sell-side liquidity? So what is it doing here energetically here? What is it doing? It's crossing over the new day opening gap. And then at 7 o'clock, what does it do on the 7 o'clock candle? Look close. Let me take this away for a second. What do you see it do? It retrades to the new day opening gap that was formed right over here. You see it touching that? So if it's going to go back to that after having displacement here, it's already set the initial boundaries for the sell stops and the buy stops. So the algorithm is giving the signal right here. Now we're inside the element of time. So the market should displace above this high, relative equal highs, challenge the initial buy side liquidity, and will test and hold to see if it can run above this high. So if we look at how the price opens on this candle, it drops back down and touches and retrades to the high of that new day opening gap. So everything's in motion. Everything is set. We did not have an interest in going back below the initial sell side liquidity that took out this low. The key things are this. We're gyrating around the new day opening gap. You want to see this. But when it comes to time, 7 o'clock is your time in Asia. The algorithm will come online and you'll see buy programs and sell programs begin right at 7 o'clock or just after it. Okay, and you're only really interested in until 9 o'clock. So if you're a working class hero in the United States, or if you're overseas and you want to trade in this time of day, your key times are 7 p.m. New York local time to 9 p.m. New York local time. Okay, so anyway, the down close candle in here, it trades down, touches the top of the new day opening gap, and now because it's 7 o'clock, it's proven that it's not going to go down here. It has no interest in it. And this run here, this right here, that is indicative of that it wants a run. So because it's doing this buy side imbalance, sell side efficiency, I would have no interest, as you saw last night. I'm not interested in seeing it come back down into that gap. So what does that make this gap? It makes it a breakaway gap. And so if it's going to break away from running higher and not going lower, what's it going to seek? This short-term high. I want to see, does it have momentum and speed in which it takes that relative equal high out, this high and this high. When it trades there, which it does right there, it pops through it real quick and then comes back half of this range, consolidates around it, boom, runs into initial buy side liquidity. So now I want to see this, treat it as rocket fuel. You don't want to see it go up and then go right back in, because what that was is it's a fade. That's your turtle soup. It's a fake out. What we're looking for is we want to see like a nitrous oxide injection of strength, speed. When Dad does and I'll type out and say, I want to see speed and magnitude. I want to see distance. That's because I'm I'm expecting these elements in price action. At that moment, I want to see that being visible in price. And you can see it happening here. And then we gap up. Where this candle closed, it gapped up here. When we trade back down into that, right there, that is an entry as well. This is an actual wonderful buy. And then we start to roll up here. Then we see the classic volume imbalance, retrade to it there. And that's another buy. And then you have this big pop here. Well, it runs up there and took the buy side here. So visually, you can see how in this candle, I'll put that right over top of it. You can see the entry right there. And what I was aiming for is I wanted to watch when it opened and traded down. I wanted to see it get below the body of that down close candle. I don't care where in the spectrum of that wick, because that's a discount wick. I'm buying that order block because I understand it's an order block. Everybody else will simply say, well, you got to look to buy the down close candles. And that just shows that they only listen to my very first introduction to an order block because they don't understand what an order block is. So I want to be in the discount element of that down close candle, and I want to be entering below its body. I want to be buying below that, at it or below it. And then it rallies. And when you have this break like this, your stop loss has to be below the consequent encroachment of the new day opening gap. Because we gapped up like this, and we've already done this. Watch what we've done. We've opened here. We created the new day opening gap. We took short-term liquidity here, took short-term liquidity here, and then we crossed back over top of the new day opening gap, and then crossed back down below it. And then now we have this displacement ahead of 7 o'clock. You see that, folks? You see how that element of just, it's letting everybody know that sees price with this understanding. These are the little hallmark signatures that, okay, it's about to happen. So now we have to reference these completely random levels. This touch of that high of the new day opening gap, that's your trigger. But I want to get in there right as it's trading back to that wick. The market has immediate feedback and tells me I'm on side. I don't need to worry about anything now. And as soon as we take out this high here, the stop goes to break even, or at the very minimum, it has to be at the top of the new day opening gap. So the market gives us two qualifying, comfortable, like consoling, like it's okay, don't worry about it. It's coming because we see the displacement here. And when we see the displacement, every displacement does not have to see it trade back down into. It's better for your trades to not see them return into buy side imbalance, sell side efficiency at all. That's what you really, really want to see, okay? If it has the interest to go back into it, that is indicating that if the move's coming, it's being deferred, and you're going to have to sit through a period of uncomfortable waiting and maybe a little bit of drawdown or chopping it around before it takes off. I don't like those types of trades, which is why I like to look at the market when it creates these types of characteristics, where it's really indicating that, hey, it's about to pop. And it's doing exactly what I want it to do. We can time it because the market operates on time, not price first. It's time first. And you have to know what these elements of time are and why they're a factor. So there's our entry. And then we want to aim for something above this buy side liquidity pool. Because if we know that it's likely to trade up above it, how can we arrive at a target that is close to it? Well, what was the leg of price prior to this run up that's going the other direction? Can you see it's this high down to that low? So in other words, we had this movement kind of like a slingshot or a catapult. Price is winding back, and then it takes off and runs for it. You see that? Sure. So we can take this price leg here to that low, and we can get some measurements to get a baseline for range finding. So if I'm interested in a run that goes above this high here, okay? Once we have indications that we have this high taken out, which is what we get there, that's the second qualifier that really builds the confidence that this trade is going to be a runner. In other words, you should have no anxiety at all about the trade not panning out, because we had this ahead of time, right, going into 7 o'clock. We already worked above and below the new day opening gap. We kept initial sell side in play there, and now we refer back to this one. So this is the buy side. So that's where your initial interest is. Do we have the momentum and interest to power through that? Because it could have very easily done this. It could have went above it and then started to break down. And that would have been just simply a losing trade. And there's nothing to be afraid of with that. But it's not likely to do that if you have something like this where it starts running energetically, proving that that low is now not interested to take out that low. And now the buy side here and here and here is where we're focusing on. Because the Johnny come latelys that didn't trade yesterday and they weren't bullish, they're trying to get in board. They're trying to get on board because now the market started trading at 6 o'clock and they're trying to buy anything that gives them a reason to be long. So I want to capitalize on that and know that any rallies that it forms is going to be short-lived. So I have to know beforehand, where are my exit points? So how far can it run up above this buy side liquidity? Well, we're range finding by taking the fib from here to here, and all we're doing is measuring the distance between that low and that high, and then duplicating it, okay? Going up one measurement of that and then a half, which is why we have that standard deviation there of one, that's negative 1.5. So what that is this range from high to low times 1.5. So you get a baseline. In other words, let me show it to you like this. What that will be is a perfect measured move. So in other words, it's from the low to this high. Perfect duplication added to this high would be here. Okay, so that would be a good place, to take a partial. If we had more than one contract on, we could have took a partial there and had a limit order to sell there and then aim up here. So all you're doing is you're watching what price is doing. The only difference is where we have the new day opening gap here. Instead of the new day opening gap, what we're going to be looking at is the 30 minutes after 12 o'clock to 12:30 New York local time, because that is your opening range for London. But anyway, this is what I love. I teach this in the mentorship stuff too. Everybody's like, yeah, it's creating a bull flag. You see how it runs up quick, consolidates, and they want to see another leg of that repeated up. Mm-hmm. That's fake. But it breaks down. It responds back to what level? Where old initial buy side liquidity was. Why this creates an important turn here is because of what I outlined over here. It's initial reference points that the algorithm is going to refer to. We sweep back down below the new day opening gap after touching the initial buy side liquidity reference point, and then drops lower, goes back into that volume imbalance there. And then we cross back below new day opening gap. So what's below the new day opening gap that formed last night at 6 o'clock? We have the new week opening gap high. So that's the next level below us in terms of new week opening gap or new day opening gap. So now we know we can potentially draw down into that. We're digging into the new week opening gap that was formed this Sunday that just passed, okay? We trade up. We're gyrating around the old level that was formed at 6 o'clock sell side liquidity. See how it's referring back to that? It's gyrating around that, okay? Anyway, we had this consolidation, and then we rally back up, and we're back into the new day opening gap, and then we trade right back up into a reference point for that old liquidity that was outside the initial buy side. You see that? So we have a previous day high. We return back to it here, bump, bump, gyrate around the initial buy side liquidity. Same thing here. We have that run up. It looks like a bull flag. Retail's going to say, oh, it's going to run higher. No, it's not. What's it doing here at 12 o'clock in the morning? All this run goes down to a random midpoint consequent encroachment of the new week opening gap. From 12 o'clock there, okay, so 12 to 12:30, right there, okay? That is your opening range for London, okay? That range, the highest high and the lowest low between those two price points, okay? Think of it like the opening range at 9:30 to 10 o'clock in the morning, which is what we're involved in now for the opening bell. You extend that forward in time to the right, and you'll see that the market will refer back to it, in addition to how it goes back into the new day opening gap that formed last night at 6 o'clock. What is this level right here? See, I'm testing it.
That's the initial sell side liquidity.
Yes, very good. So it trades up, hits that, and drops. Now, think about it, okay? I'm telling you how to find the real support and resistance. Is it not respecting these levels? So it's going right to them hammering. What time of day is that forming? We have the 8 o'clock hour. We're watching to see what is price going to do. Well, we have low, relative equal lows, and it's here. So what would you expect to see? It drop. What happens if you miss this move? What happens if you see it start to drop and you miss this reaction here? What are you going to do? You're going to wait. What are you waiting for? Waiting for a fair value gap or a volume imbalance? There's a volume imbalance. And then we have the open. It trades up, goes right into that. There's your short. And what's it going to aim for? The relative equal lows that we were just looking at before I did this. over here. So you have an entry here that targets these relative equal lows and these relative equal lows. Looking further to the left, we have this down here. Isn't that a relative equal low? And where's the market go? Where does it trade down to?
A new week opening gap. Low.
Right. And then what does it do after that? Reaction. See, folks, listen. The reaction you get here and it runs up, if it's going to have this much of a reaction off that low of the new week opening gap, what is reasonable for it to see it reach for? If you're inside the new week opening gap and it's shown the willingness to want to react this way, it's the midpoint. And then if we're going to see this level breached and pierced on the upside, it does it here. It's dropping back down. Why would it want to drop back down? It's going to a discount, like a slingshot, right? Like I was saying, a slingshot. But it's reaching down into an inefficiency because there's no short-term lows in here except for that tiny one right there, which to me doesn't have all that much importance. But my eye jumps right to that. You see that? Look at the perfection there. It hits it and then and runs. Same thing over here. Fair value gap. Drops into it there after taking a short-term low out. Rally. It goes back to this level. Now from here, I want to see it trade above this high here. It does. And then we can react off of the consequent approach at midpoint. And then it runs back up to, what is this level again?
That is the initial sell side liquidity.
Right. It was derived from there.